Hey there, and welcome. Today we are cracking open the playbook the pros use to master the Indian investment scene. We're going to distill the definitive guide for financial professionals and turn it into a clear, actionable strategy you can use for your own success. All right, let's get real for a second. You're on your way to becoming a business leader. You can probably analyze a corporate balance sheet in your sleep, right? But here's a question for you. How much time have you really spent designing the most important financial plan of all? You know, your own. Well, that's the gap we're going to close today.
And to do that, we're going straight to the source. I'm talking about the NISM Investment Advisor Workbook. This is the official guide for anyone who wants to become a certified investment advisor in India. So what we're going to do is break down its most important concepts so you can use them not just to crush your exams, but, and this is the big one, to build a really solid financial foundation for your entire career.
So let's start at the very beginning. We're talking about the absolute foundation of creating any kind of wealth. It's all about building your personal financial roadmap.
So, what exactly is financial planning? The book keeps it simple. It's a process for managing your money. But it's not just about, stashing cash away. It's about figuring out what your big goals are. Maybe buying a house, paying for more education, or actually retiring someday, and then creating a real, step-by-step plan to make it happen. Now, at the heart of every single financial decision is this one core idea, the time value of money. Simply put, a rupee you have today is worth more than a rupee you'll get tomorrow. Why? Because today's rupee can be invested and start earning interest. And this idea isn't new. Get this. Records show that people in Mesopotamia were charging interest on loaned seeds over 5,000 years ago. How crazy is that? And this is where you can really see how powerful that idea is. Let's take an example straight from the workbook. This guy, Krishna, he invests 5 lakhs. With simple interest, over 5 years, he makes a flat 2 lakhs. Not bad. But when that interest is compounded every year, which just means his interest starts earning its own interest, he ends up with over 34,000 extra rupees. That difference, right there, that's the magic of compounding. It's the real engine that builds wealth over time.
Okay, so we've got this amazing tool, compounding. But where do you actually put it to work? Well, that brings us to the real world, to the playground where all this happens, the Indian financial markets.
Look, any market needs rules to function, right? And in India, you've got 2 main players keeping things in order. First, think of SEBI as the stock market's referee. Their job is to make sure everyone's playing fair and to protect investors like you and me. And then you've got the RBI. They're like the guardian of the entire economy, managing the banks, the currency, all that big picture stuff that keeps everything stable.
Now, inside the market that SEBI regulates, it's really important to know where things happen. You've got 2 main stages. First is the primary market. This is where a security, and that's just a fancy word for a tradable asset like a stock or a bond, is born. The best example is an IPO, an initial public offering. That's when a company sells its shares to the public for the very first time to raise money. But after they're born, well, then those shares go on to live and get traded between investors on the secondary market. Think of places like the Bombay Stock Exchange.
Okay, so we get the rules, we know the playground. Now, what about the tools in your toolkit? What can you actually invest in?
First up, the big one, equity. It's pretty straightforward. When you buy a share, you're literally buying a tiny piece of that company. You're an owner. You've got a claim on its assets and its profits. Now, with that ownership comes the potential for high returns, but it's a two-way street. It also comes with higher risk, because the value of your piece of the pie can go up or down.
All right, the other major category is fixed income, which you might also hear called debt. This is totally different from equity. Here, instead of being an owner, you're the lender. You're basically loaning your money to a government or a big corporation. And in exchange, they promise to pay you back with regular interest payments along the way. Generally, it's lower risk than equity, and it gives you a nice, predictable income stream.
So here's the most important part. You don't have to pick just one. In fact, you absolutely shouldn't. A smart portfolio is all about the mix. You can see in this sample portfolio, you might have some Indian equity for that high growth potential and some fixed income to provide stability. And you can own these things directly, or you can use something called a mutual fund, which is basically just a big pool of money from lots of investors that a professional manages for you. And maybe you'd even sprinkle in some alternatives like gold to help balance things out.
All right, this brings us to the very top of our pyramid. We've laid the foundation, we understand the landscape, and we have our toolkit. So the big question is, how do we put it all together and create a winning strategy?
And the answer, the master strategy, is something called asset allocation. And listen, if you only remember one thing from this, make it this. It is not about trying to pick the next hot stock. It's about deciding how to slice up your investment pie. What percentage goes into equity? What percentage into fixed income? That decision, right there, is what will drive almost all of your long-term results and control your level of risk.
Okay, so once you've decided on your asset allocation, then you can think about which specific investments to choose. And here, there are really two big schools of thought. First, you've got fundamental analysis. Think of this like being a detective. You dig deep into a company's health, its financials, its management, its industry, to figure out its true intrinsic value for the long haul. On the other hand, you have technical analysis. This is more like being a weather forecaster, but for stocks. You're looking at charts, price patterns, and market sentiment to predict where things might go in the short term.
Wow. Okay. We've covered a ton of ground, right? From the basic building blocks all the way up to strategy. So now, let's bring it all home and boil it down to the core principles you absolutely have to remember for success.
So here are the key takeaways you should write down. First, your financial plan is your roadmap. Without it, you're just guessing. Second, compounding is your superpower. It's the most powerful wealth-building tool you have. Third, remember the players. SEB is the ref, and the RBI is the guardian. Fourth, know where you are. Securities are born in the primary market, think IPOs, and traded in the secondary market. Fifth, and this is huge, your asset allocation is way more important than picking individual stocks. Next, you got to pick your style. Are you a fundamental detective looking for long-term value or a technical analyst chasing short-term trends? And last but not least, always balance risk and reward based on your own personal situation.
So there you have it. The professional's playbook is officially in your hands now. You've got the exact framework the experts use. So the only real question left is, what's your first move going to be? How are you going to take these ideas and start building your own winning portfolio starting today?